Well, if I do a Roth conversion of $25,000 more, I take $25,000 of IRA money, pay taxes on it, move it to Roth, and which of those two rates am I going to have to pay taxes on? Effective or marginal? And the answer is neither. And that's the mistake.
All right, Zacc, we have you back. We have done a lot of conversations around this. And I wanted to preface this one with, I had heard this phrase, data over dogma. And I couldn't remember where I had heard it from. And I've since looked it up, and there's an actual podcast on this on a religious topic, and that's not where we're going here. But I think when we talk about things like Roth or traditional or politics, religion, any of these things, I think that it's important that we analyze things from a data perspective rather than a dogma perspective of getting so latched on to a religion of insert whatever. I have it in the Medicare world of Advantage versus supplement plans, right? And so when we talk about Roth and traditional, I think that that's what I love having you on here is it's not one way or the other or die. There are a lot of options here and looking at it from a very specific scenario. So as we build on this with the Roth conversations, this video is all about ways that people can Roth wrong. And so for those who are Roth or die, this might rub them a little bit the wrong way, but just try to take a step back. We aren't saying that Roth is bad. There are just some things that I think people need to look at before they make those decisions.
Totally. Man, I was brave to start out with religion and politics you came out swinging. I like that. I'd never heard data versus dogma. I like that a lot. I think a lot of people get totally fixed on one way or another here. And it is all about just diversifying investments, diversifying tax structure, understanding the benefits of each and understanding how they work and how they benefit you. There's a lot.
Yeah.
We have come up, and also people should know we're not negative Nellies here, right? There's 16 ways to do this wrong, but this is just one video. We've got an episode coming on this channel for how to do it right. I've recorded that with Tyson Long on my channel, how to do it right. We've talked about the basics, the 8 advanced reasons. So we've covered a lot on how to do it right and how to understand it. We'll hit the 5-year rules later, but this is all about the mistakes people make. And I feel like in the comments of all the other videos, I feel bad saying this, but I'm just going to throw it out there. I started with 5 ways to do it wrong. Mm-hmm. And then there were so many comments or so many things, questions, wonderful questions, right? Yeah. But sometimes they exposed that people might have been thinking about it wrong. Yeah. And so it pushed the number up to 16.
Yeah. I just looked at this. We passed 65,000 comments on the channel. And so
are you serious?
It's a lot of, so that's where it's as these are coming up, I think it's so great for us to make videos around these comments because these questions come out and then we're able to help people in a different way. So we love people commenting, not because of engagement, and that's great, but it gives us the chance to come up with better videos like this.
If you can get over the scars from
the emotional
damage. How many of those were about the size of my hands? Because we had quite a few.
64,000 of them.
Those of you who aren't listening, early on, somebody was like, man, look how small his hands are. And then we used that as a code word at the end. So anyway, it was a good time. How do we do this, Erik?
Well, what's the first mistake people make?
Let's dive right in. Misunderstanding commutative property. Mm-hmm. This is the idea that A times B times C times D. Let's go. We have 4 different numbers in a row that we're multiplying. That somehow, if you change up the order of these, that it ends up at a different value. People think A times B times C times D is different than A times C, D, B, and it's the same. It doesn't matter. So they misunderstand, and I'm going to give the letters an assignment. The beginning balance is A. The tax rate is B. The number of years you have to invest would be C. And then the growth rate is D. So the idea is if you have a tax rate, time to invest, and growth rate, and you're starting with a beginning A balance, if you put the tax second before the years and the growth, that's Roth. Or if you put the tax at the very end, that's traditional. You do the years and the growth first. It's not going to come out to a different number if all the numbers are still the same in a different order. And for whatever reason, people think, yeah, if I pay the tax now on a smaller balance, it's going to end up different, even if I multiply the same rates of return over the same number of years.
Yeah.
And that's just not the way math works, unfortunately.
Yeah. Yeah, and it's important too. That comment has come up a lot of we've used examples of 8 years or 10 years that it's invested, and people say, well, if you drew this out to 20 or 30 years, you'd have a different outcome. And it's like, no, it
Or
doesn't.
1,000.
Yeah,
It
you
doesn't
can
matter.
put out as long as you want, as long as those other variables are the same. It's the same number.
Yeah. And it is in understanding that it's all the same that you finally understand how to strategize. Because if you somehow believe that there's some difference because of the order, you're going to come out with false recommendations, like false assumptions as to what the right decisions are for you. But once you understand that it's the same spendable concept, another way of describing this is same spendable, which we've talked about in previous episodes, so go back to that. But if you end up with the same spendable, with the same tax rate, same growth rate, same number of years, then all of a sudden that enlightens you to realize like, okay, but if we tweak a variable because the rate's higher or lower, or we tweak one of the variables here and there, it changes everything.
Great. I think that covers that great. And we've talked about that in other videos too pretty extensively. So what's number 2?
This is confusing because people get mixed up between effective rates, marginal rates, and marginal cost of the conversion. So we're talking about Roth conversions in this case, or maybe not just the conversion, but so stack all your income that is going to happen whether you choose traditional or Roth. And that means that you can say the last bit of income you're paying taxes on if you choose Roth is stacked on top if you choose Roth. If you don't choose Roth, it disappears. If you go traditional, this could be for contributing to your 401k at work. That money disappears from your taxable income if it's traditional, or it's recorded if it's Roth. So once again, you just let all your income sit there, let the Roth traditional decision sit on top. And the definitions are the very last dollar that you paid taxes on, that rate that got, that just the very last dollar, the rate associated with that is your marginal tax rate. It is not the rate that gets applied to every dollar in the whole stack. Your first dollars are 0 because of a standard or itemized deduction. Then the next dollars hit 10%, and then 12%, and 22%, and 24%. And this is our current tax code as of 2025. That could change in the future, of course. If you tiptoe barely into the 22, it does not mean that the government now takes 22 and applies it to the whole stack. They just apply it to the piece that went in. So people get confused because they say, okay, well, my effective rate, which is the average of all the taxes I have to pay across all the income, it was only 13%. My average might have been 13. My marginal is 22. And they think, well, if I do a Roth conversion of $25,000 more, I take $25,000 of IRA money, pay taxes on it, move it to Roth, and which of those two rates am I going to have to pay taxes on? Effective or marginal? And the answer is neither. And that's the mistake, because it's not 13. There is no 13% tax bracket. You're not going to stack money inside the 22% tax bracket and have it somehow work out to be 13% because the government's like, yeah, you are averaging 13. You're right. We'll only charge 13 on this. That's not how that works. Nor is it always perfectly 22. It's definitely closer to 22 than it is to 13. But what happens when you stack that $25,000 conversion on top, that might impact your Medicare premiums. That might impact your Social Security taxability. That might impact your eligibility for other healthcare benefits or private insurance or exchange. I mean, there's so many different factors that play into that. That might push you into something called AMT or not. That the tax return itself has so many levers and there's so many consequences. It's this domino effect of adding $25,000 of income might not just be $25,000 times the bracket that you're sitting in. It might actually like pull in some additional income. So maybe instead for that $25,000 of conversion, you actually had to report 30. Well, how do we calculate the tax on the extra $5,000 of income? There's tax on that at 22%. Let's say you're still within that bracket. So we're figuring 22% tax on $30,000 of income. That dollar amount was your marginal cost of the conversion. And I like to take that and turn it into a percent of the $25,000 conversion. And now I know that that was actually 23, 24, maybe 25%. And even though I was in the 22% bracket, the conversion cost me 25 or 26 or 27. The most common scenario for this is when you take additional income and you're inside the tax torpedo, which we've talked about this, where the Social Security tax calculation where when you add regular income, it pulls in more of your Social Security to be taxable. So you might have done a $20,000 conversion and that pulled in $20,000 more of Social Security. So you actually pay taxes on $40,000 for the 20, and the tax rate gets pretty heavy. The marginal cost of conversion, the rate associated with your marginal cost of conversion. So those three terms, your marginal rate is the rate on your last dollar. The effective rate is the average across the whole stack. And your marginal cost is literally what did it cost you to do that conversion, or what did it cost you to contribute to Roth at work instead of contributing to traditional.
Yeah. It's so hard. Like we make these videos and the assumption is, because we've done them so many times, is that people have seen all of our videos. But for those who haven't, you have a Social Security taxability worksheet that is this exact conversation of people can plug in their own numbers. We'll link to it here so it'll pop up somewhere.
Yeah,
but
I think we've done like 30 versions of that with all of your comments around, oh, change this, make this look different.
Yeah. And so that'll pull in. I love how you described it as a tornado because it's pulling other things in, but it'll illustrate that really clearly.
Got it. Number 3 is magic taxes. So magic taxes are a false equivalence if you understand logical fallacies. You're comparing two things that are not equal and they appear to be equal. So you have this situation where someone says, well, if I put $10,000 into a Roth, I'm going to walk away with way more money than if I put $10,000 into a traditional. And I agree with that. That is correct. But $10,000 to a Roth, if you have a 25% tax cost associated with that, is more like $13,333. So why didn't you invest $13,333 in your traditional? And then we do this game where people are like, okay, well, I'll do $13,300, but what if I do $13,300 in the Roth? And we're like, well, okay, the way you figure that out at a 25% tax bracket is you divide by 1 minus the tax bracket. So 1 minus 0.25 is 0.75. You'd divide by 0.75, and you'd figure out that it's not 13. Now we're up to 17 something or 18. And you would just keep going until you hit the maximum amount that you can contribute to a 401k, for example. And then at that moment, they're like, gotcha, because can't put any more in that traditional. And that's true. However, you can contribute unlimited amounts to regular investment brokerage accounts. So depending on their tax bracket, it's still, especially in a high tax bracket, it still may make way more sense to do the maximum contribution to a 401k plan in traditional, and then the tax savings going into just a non-retirement brokerage account where you're buying stocks and growing at a similar rate, or buying investments in general. So it's this false equivalence of magic taxes that the Roth is somehow better, but they don't account for the fact that they actually had a tax cost to get there.
Yeah. And in that example, so I've had a lot of comments that have come up on this, so maybe you can tackle this real quick, is that what you just described is like sometimes the Roth looks better than it maybe is. On the other side, I've had comments of like that traditional, so that now it's that $13,333, you're getting an additional tax break of that $3,333, which that's going to create a dollar amount that you could reinvest, and that creates another reduction in your taxes that you could take and reinvest. And I've had this infinite loop of tax savings off of this traditional contribution thing that is not correct. So maybe you can outline.
Well, that's kind of like you have an electric car now. That's kind of like somebody saying, if I just drive up a hill and use the charge to go up a hill, and then I just use the regenerative braking to go down, I will infinitely be able to go up and down hills because I'll charge it completely. Like that's the math they're missing. The reality is if you have $13,333 that you're contributing to a traditional IRA, you're saving taxes on the whole thing. If you weren't, if you paid taxes on it, you would have, and when I say the whole thing, it's not just the $3,000, it's the whole $13,333. You would have $10,000 after tax. So it's either $13,333 before, $10,000 after. You contributing $13,333 doesn't create way more that then you can stack on top, or else you could do an infinite loop of saving money. It would be like a full-time job for you to just keep saving on the infinite. Now, technically, you'd get down to a zero limit at some point, but it just mathematically doesn't make sense. I don't know if we want to go too far.
No. It was just again, there was like the idea of those who are very dogmatic about traditional. It's like you'll always win because of this infinite loop that doesn't exist. And then there's also the dogma on the other side of the
yes. So just make sure the bigger one I see is just the fact that people miss understand. They're like, well, I'm contributing $15,000 to my 401k either way. And I want to say, well, that's a behavior problem. At that point, it's not, I don't mean to be like mean or anything. I'm just saying like, but then it's your behavior to choose in one scenario to put $15,000 in your 401k and pay about $5,000 in taxes if you're in that bracket. That's a pretty heavy bracket. But that's your choice. And then over in this scenario, put $15,000 in your 401k and not pay the $5,000 in taxes. Well, in that scenario, why aren't you willing to invest the other $5,000? Like, I just don't understand. And there are behavioral aspects to this where it's like, but I don't end up investing the other $5,000. And if it's like, okay, that's fine. If mathematically you're okay paying more in taxes over your lifetime because you're in a high bracket and you probably should be doing traditional, but you just can't get over that and you're doing Roth because it just is easier, that's okay. But I just want people to know what decisions they're making.
Yeah, again, there's the false equivalency. The math isn't the same doing what you just said with the behavioral thing being different. All right, what's number 4?
Number 4 is something that I was taught at a previous employer, and a lot of big financial institutions teach this in many cases where they say, okay, we've done this Roth conversion analysis. Do you have money? Because Roth conversion, you take money from your traditional account, convert it over to Roth, you pay taxes in the meantime. And if you are below 59.5 and you take money out of your account at all, like, and moving it to a Roth is fine, but let's say you take money out to help cover your tax bill, the government says, hey, you took a withdrawal from your account before 59.5. That's not okay. In certain circumstances, you might be taxed and penalized on the money you withdraw. Now, we consumers are like, but I gave it all to you. I paid taxes. I gave it all back to you. And they say, we don't care. That's kind of like a withdrawal. Maybe you put that in your bank account and you used other money to pay our taxes. They don't really, they don't think about it that way. So it can be taxed and penalized. But setting that aside, let's say someone's old enough where they don't have any penalties to withdraw. And this is the retiree who's above 59.5. And they're being told, if I don't have money in my bank or money in a non-retirement regular old brokerage account to cover the tax bill, that a Roth conversion is wrong. And I can't figure out why. I think it's a conservative, and it's a conservative view it's a rule of thumb without maths to support it.
Yeah.
So here's why. Under that same logic, then we should all be telling our retirees that unless they have money to cover the taxes on their regular withdrawals from their IRAs, that they don't get to withdraw from their accounts. So either they're going to pay the taxes now from the account on a conversion, or they're going to pay taxes on it in 20 years when they withdraw, or 10 years when they withdraw. I don't really care if it's coming from the account or not. Is it better if they have other assets? Yes, because that means more gets converted to the Roth and it works out better. But is it prohibitive? Does it mean that the Roth conversion is completely a bad idea? No, that's wrong. That's the mistake.
And to summarize that just in Erik's brain is that if I'm doing a Roth conversion, then I have the option to click a button and say those taxes I want to be paid out of my Roth,
Conversion.
that conversion of those assets being moved, or I have my checking account with money set aside and I'd rather pay it with that. So you're saying clicking it to pay it with the conversion itself under 59.5 could be an issue, but over 59.5, it's not a problem.
It's not a problem. Is it the most optimal way of doing it? Probably not. So let's do a big number, $100,000 conversion and a 25% tax bracket. So there's $25,000 in taxes to be paid. You can choose either to have those taxes withheld as part of the conversion and $75,000 hits the Roth. Or you can say, no, don't withhold anything. I've got $25,000 sitting over here in the bank. I'll pay that tax bill, and that way $100,000 hits my Roth. That's better. Don't get me wrong, that's better. But let's say you don't have that $25,000. Some institutions and some advisors are saying, since you don't have that cash, you shouldn't do any conversions. And that's where the mistake is.
Gotcha.
Because if you're going to withdraw the $100,000 next year or a year later or whatever, for whatever it is, and you're going to have it withheld to be able to spend the $75,000, why shouldn't you be able to move it over to a Roth and have the $75,000 grow to $90,000 and then spend it?
Yeah.
Makes sense to me, though.
Yes. Perfect. Okay, what have we got next?
Okay, looking at 1 year tax savings. Roth conversion strategies are not a 1 year strategy. It is too short-sighted, one, and the you have to go back and listen to the first episode about tax rates rising and tax rates dropping to really understand this well. But sometimes people will look at like this myopic view of this year. What's good this year? Well, in that case, traditional is almost always the best, right? Because you get a tax break if you're at the right income levels and the right account types. So traditional almost always wins if you're looking at 1 year alone on the saving side.
Yeah.
On the spending side, Roth always wins because you take it out at tax-free. So it must be at least a 2 year. You can pair a year in the future versus a year now and say, like, I think I'm going to pay a lower tax bracket later than I am today. That's traditional. I think I'm going to pay a higher tax bracket later than I am today. That's Roth. Now, it's better to not just even look at it at 2 years. You want to look at the whole retirement span in retirement and pre-retirement to determine average, like what are my rates like for the most part. Set a target, and then you're converting and taking income below certain lines and avoiding it above certain lines. So that's for our next conversation about how to do it right. But the mistake is looking at it in 1 year by itself.
Yeah, I think that's so important in a lot of the other videos that you've brought up, is that this isn't a 1 year decision. And you've even mentioned in different things of you could have a situation where somebody's in the 24% marginal tax bracket and a Roth conversion makes sense for them, but an equivalent person also in the 24% rate where it's not, because one later in the next few years is going to have their rate drop and another is going to have it go up. So you're looking at the same person, same income, same rate, and the decision is different.
Yeah, it could be Roth or traditional.
Yeah.
Yep, not because of that year, because of that year compared against their retirement years.
Yeah.
And like you said, comparing against their retirement years, it might be higher or lower than 24. So we want to look at that.
Perfect. All right. I think we're on number 8.
Number 7.
Number 7, sorry.
Number 7 is using different growth rates to determine if a Roth conversion or Roth contribution is appropriate. So of course you would invest your Roth more aggressively. That makes a lot of sense. And I've heard many people say, well, because I invest more aggressively, even if the tax rates are the same and the time is the same, I'm going to end up with more in Roth. And 100%, I agree, because you changed one of the variables. You changed letter B or C in there, right? You had the same beginning balance, same number of years, different growth rates, same tax rate. Doesn't matter what order you put those in. If you have a different growth rate, the higher growth rate is going to pay off more. My problem with that is usually when you do this, if you go to the extreme, the math becomes more obvious. So let's say somebody is in the absolute highest tax bracket. They're paying 37% federal, and they're in California or New York, and they're paying 12+% state. They pay half of their income away in taxes. So should that person convert $1 million over to a Roth, have it turn into $500,000 after taxes, and then grow on that? But they invest their $500,000 really high growth. Maybe they're earning 10, 15+% rates of return. Okay, they might argue, I still can outperform my conservative assets in my traditional that has $1 million in it with $500,000 invested at 10, 15, 20% rates of return. It's like, okay, well, maybe in retirement, that person can take money out at 10 or 12% tax brackets because they're frugal and they're careful. I'm painting a very extreme picture, but it helps with the math. So if you were willing to invest really aggressively with a portion of your portfolio, why not just take a section of that traditional IRA and put it in a different account if you have to, if that makes you feel better, and invest that in the same way that you would invest your Roth, but instead of, invest the whole $1 million aggressively is the same as investing $500,000 in that Roth because their tax rate was so high.
Yeah.
So this person's moving to Texas from California, 0% income rate in Texas for state, and they're dropping into the 12% tax bracket, let's call it. So they can either pay half away or they could pay 12% away. And this person is saying because they invest aggressively in their Roth that they'd rather pay half their balances away in taxes. No, that's not how it works. If you're that willing to invest aggressively, just do it inside the traditional, and then we're back to having the same commutative property, same math, and it's just in a different order. Yeah. So I know that was a long explanation, But the point is, yes, of course, you'll invest your Roth more aggressively and you'll do what's called asset location. But that in and of itself might not be the reason to convert. And you might be better off not converting and just investing a portion of your traditional more aggressively.
Interesting. Seems like another video on that. I need to ask more questions on that. But
okay, because we could go deep, right?
Yeah.
Number 8, thinking an IRA is an investment and that a Roth or traditional will inherently perform better. Like somehow believing that Roth IRAs are better investments or traditional IRAs are better investments. I liken the account to the garage, and what you choose to park, what car, boat, motorcycle, ATV, bicycle, what you choose to park in the garage, and in my case, it's apparently Amazon boxes, but whatever you choose to park in the garage, that's on you, and that's the investment that goes in and out. The driver, that's the investment manager. In many cases, it's a lot of your customers are DIY, so they're the driver, and they pick their own investments coming in and out of the garage. But the account is the garage. Like the garage doesn't change how fast the vehicle is, or how good the vehicle, or how safe the vehicle is. It's just where it sits. So, and in this case, it's the tax structure, and that's where it sits, the Roth or the traditional. Some people have in mind, the mistake is they have in their mind that inherently Roth or traditional is somehow a different investment, and typically you choose the investment after the fact.
Can I confess something to you?
Go ahead.
4 years ago, I thought that way.
Most people do.
Yeah. It wasn't until I started having these conversations with you and your team more often, because this wasn't my world. Finance wasn't my thing. And so coming into here, I was like, okay, I want a Roth account or a traditional account. And that's the same thing regardless of IRA or 401k or whatever. And you guys were very kind to educate me on
Well,
that.
you're kind to be authentic like that. When I was working at an architectural firm in college, I called Fidelity Investments because they had a 401k plan. And I was so nervous that they would find out that I didn't understand anything that I ended up in a fund that was appropriate for someone who was 65 years old, and I was barely 20 something, but I was fine with it because I didn't even know until much later that I had made that. It's just easy to be intimidated by all of it.
Yeah.
Okay. So one is not inherently better than the other. They are not investments themselves. They are the location in which you hold them.
Yeah. Perfect.
Number 9 is forgetting about automatic tax diversification through matching. We talk about a concept called degrees of freedom or flexibility or tax control in retirement, marginal tax bracket management, whatever you want to call this thing. It is the ability to have levers to pull in retirement that you can control how much income you show and manage 2 certain lines in retirement. It is amazing, and retiree tax situations are really good when you have a little bit of control with an advisor or an individual who understands taxes well. So most advisors, it seems like, or many advisors, it seems like, don't seem to pay much attention to marginal tax brackets on withdrawals. If you do it right yourself, or if you have an advisor that does, you can really control your tax bracket. But the mistake here in number 9 is forgetting that you're getting that tax diversification through matching. It is, since the most recent version of the Secure Act, an employer could match with Roth dollars if they wanted to. But I have yet to come across a plan that does. I know they're out there, but I just haven't run into it.
Is that because the employers just aren't set up to do that yet, or what is the reason?
Yeah, and they haven't chosen to offer it.
Yeah.
It is, so within retirement plans, it has to be legally capable or legally available, and then after that, employer capable. So it is legally available. I don't know of very many employers who are capable or interested in making themselves capable. What happens when you do a Roth match is now you have to charge taxes on the match to make sure it turns into after-tax dollars. So let's say you contribute $20,000 to your 401k and you get a match of $10,000 for the year. Well, now you have to reduce your employee's you have to increase your taxable income by $10K in order to cover the taxes. So they're going to report on your W-2 an extra $10,000 of income that you have to cover taxes on.
So it seems like it's more work, and there's not really an incentive for employers.
Not until employees say, "I really want it."
Yeah.
So they don't have that incentive. So we have a situation where even if you make Roth contributions, you're getting pre-tax or traditional matching. So you're getting automatic tax diversification across the 2. So as you think about it, a lot of people will make the mistake that their selection is either taking them all traditional or all Roth, which is not the case. Even if you're all Roth, still getting probably some pre-tax contributions.
Cool. I think we're into double digits now.
10. We're getting there. Number 10 is, I cannot tell you how many times. So I told a story of a guy who had income of $600,000 a year, and he was making Roth contributions to his 401k. And then I told him, I met him at this time, it was like 2 or 3 years prior to retirement, and told him, you've got to stop, because he and his wife are so frugal, and still to this day, very frugal. They spend like 1/10 of that amount in retirement, like $60,000 a year. They are the sweetest people I've ever met. I love talking to them. I love just the humble nature. They're great savers. Anyway, wonderful people. They spend $60,000 a year. When you are in retirement, your spending becomes highly correlated to your income, your reportable income. Why would you take an extra $200,000 a year from your IRAs if you don't have to? The only reason you would is maybe Roth conversions and other purposeful tax strategy. But when you're working, it's like, I'm just trying to make as much money as possible, and my spending might not be perfectly tied to my income. Ideally, it's not. Ideally, it's less, right? So in this situation, they were making Roth contributions, paying taxes on a reportable income of $600,000. And then they could have gone traditional, saved that high tax bracket, and literally 3 or 4 years later withdrawn that same money back out at 10 and 12%, maybe 22. So a difference of only 2 or 3 years, and we could have saved them 20+% in taxes, which we immediately did. You're making traditional contributions. Okay, so that's the background to this situation. Cannot tell you how many comments I got saying, you can't contribute to a traditional if you make $600,000 a year. That's true if it's an IRA. So this mistake is mixing up the income limit rules with 401ks and IRAs. An employer-sponsored plan like 401k and 403b does not have the income limits for deductibility of traditional IRA or contribution eligibility for Roth IRAs. So real quick, without going too deep, if you make over a certain amount, you can't even put money in a Roth IRA. That's the point they're trying to make. But that's IRA, not 401k. That rule doesn't apply to a 401k.
That was on our very first video that we did that for a long time held the #1 spot on the channel of most views. And so a couple hundred of those 65,000 comments were this exact thing of people saying you can't do that.
It happens. So it's 2025. And the limits for a single person, if you make below $150,000, you're going to be able to contribute to, and this is modified adjusted gross income, which we've also talked about there are many different modified adjusted gross income definitions. But anyway, below 150, you can contribute as the full contribution amount to an IRA, and then above 165, you can't contribute anything, and that $10,000 or $15,000 spread between, it's a partial eligibility. So they phase you out. Same thing for couples, it's 236 to 246. Okay. So if you're out there and you're thinking like, what's a good income goal? Try to make yourself ineligible to contribute to a Roth IRA. That was one of my goals like early on. I want to be making enough money that I can't contribute to a Roth IRA anymore. Okay, so those are the income limits, and then the actual contribution limits right now is $7,000 plus an extra $1,000 if you're over 50. So you could contribute $7,000 or $8,000 if you are under $150,000 for single, $236,000 for a couple, and then it phases out, and then eligibility goes away. Now, the deductibility rule is way different on an IRA because they throw in this thing called active participants. Like, do you have an option to use a 401k at work that doesn't have these limits? If you do, the deductibility rules are different. They're lower. And then they ask you, okay, but does your spouse have options? And then what about filing jointly versus single? But like a non-active participant married to an active participant has much higher limits. If neither you or your spouse have limits, because neither of you have a 401k option or retirement plan that makes you what's called an active participant, it's not just 401k, like a pension could do it too. You don't have to worry about deductibility rules on your income. So in that case, you could have somebody who has $600,000 who could contribute to an IRA if they're not eligible for any retirement plans through work.
All right. That got more complicated than I thought it was.
It's a mess.
Yeah.
Hopefully people were able to follow. You do great with visuals. Good luck. Okay. So also, this is related. Number 11, thinking that the income limit rules apply to conversions. So the government's glad to have you pay taxes right now.
Mm-hmm.
So you want to convert. I actually did at one point have someone convert almost $2 million of a Roth conversion in 1 year from traditional to Roth. That was so extremely rare. And it took a while for me to get on board because I was like, it doesn't feel right. The situation is the individual had so much income from a pension that they figured they were going to be in the highest tax bracket for the rest of their life. They were a top executive at a really big firm, and that income was just coming, and they were like, I'm going to sit in the highest tax bracket forever. That was back when the highest tax bracket was 39.6. So it's now 37. So technically, I don't know if that actually was the best thing because there's 2.6% difference between what it was and what it is today. But like most people, he said, there's no way tax rates are going to go down.
Mm-hmm.
But his did, from 39.6 down to 37. So it was almost 20 years ago. But he also had a really good attitude about it. He said, it could be different. It could be lower. I don't care. It's going to be really easy for me to know what's going on with my retirement tax situation from here on out.
Yeah.
So he converted the whole thing.
And so the point of this number 11 is that your income limits don't adjust.
He was in the highest tax bracket.
You can still do that conversion.
You can convert however much you want. You can make as much as you want on your other job or other life or other income and convert as much as you want. It's pretty rare that I would be in a high tax bracket and also advise that you do a big conversion, but I mean, the scenario could exist.
I don't know if it applies to these last two, but, and this could be on the next video of the right ways to do Roth, but kind of the backdoor Roth conversion strategy here. Would this come into play with people who are messing with these income limits?
Yes, but that's a tricky one too. I actually feel like there needs to be like a whole section on direct rollovers, 60-day rollovers. What are rollovers? What are transfers of assets? How's that different than a rollover? What gets reported in taxes? What is a backdoor Roth contribution? A mega backdoor Roth contribution? There's so much. I'm actually working on organizing all of the what's called transfers and rollovers together into like a bigger discussion. Okay. But since you asked, a quick way, we actually did I think we can get there because of what we already covered. So let's say that you make too much money to contribute to a Roth IRA. Well, in that case, you still can contribute to a traditional. You just can't get a deduction for it. So let's say you've maxed out your 401k plan at work and you've done as much as they'll possibly let you, and you still want to put money aside. You obviously could just put it in a regular brokerage account. But before that, if you wanted to, you could contribute to a traditional IRA. Now, you've maxed out you've gone through the phase out. So the government's going to say, that's fine, but we're not giving you a tax deduction for that. So all of a sudden you have after-tax money sitting in your traditional IRA. If you put $7,000 of after-tax money in a traditional IRA and it grows to $10,000, when you withdraw, you will not pay taxes on the 7, but you will pay taxes on the 3 of growth.
Okay.
So that's how an after-tax contribution that gets left in the traditional ends up causing you some taxes on just the growth in the traditional. So that's one option. The problem with that is people don't like to have what's called basis inside their traditional IRA. You don't want to have like how much of this is after tax and how much of this is before tax and how much is growth versus cost. Like it's just too much and people don't like that. And there is a form that you can track it and you can report it on 8606, I think is the number, but it's just not fun. So a better way of doing this is you can take that $7,000 that you contributed after tax. You've already paid taxes on it. You can do a conversion from traditional to Roth. And since you've already paid taxes on it, there's no tax cost to convert it over to a Roth. Now the growth of the extra $3,000 is happening inside a Roth, which is tax-free, instead of inside the traditional, which is taxable in the future.
Got it.
That's a backdoor Roth contribution. I personally don't like to call them that because it sounds like a loophole. And what it is it's a conversion of after-tax traditional contributions. Same thing. My verbiage is less exciting, but it's less scary for me to say out loud. So,
and I think, like, again, as we go through those transfers, rollovers, all of that stuff, I think there's some other things at play there too where you can't have certain accounts and can't.
Yeah, the biggest, and I'll give you the one answer right now and we can move on, but the biggest problem with this is that when you do the conversion, they do not let you isolate just the $7,000 if you have more IRA money. You can't be like, I've got $300,000 in an IRA, but I only want to convert this $7,000.
Mm-hmm.
What they're going to, actually, I'm going to make the math way easier. Let's say you have $700,000 in an IRA and you've done this $7,000 worth of after-tax contribution. Therefore, 1% of your account is after-tax, 99% is pre-tax. In that conversion of the $7,000, you will pay taxes on, as a taxable conversion of pre-tax money, on 99% of the $7,000. You have to do pro rata conversions based on this tax structure of the rest of your IRAs and 401ks. Well, sorry, start over. Not 401ks. That's the whole, I was getting ahead of myself. So what you can do is you can take that IRA, you can actually roll it back into an employer plan, like a 401k plan, and it no longer is considered IRA money.
All right.
So we did this. I did this for myself and my wife. And I took my old 401k and I had moved it to an IRA and I was investing it there. Now at our firm, I feel like I was in charge of building our 401k. So I was able to get low cost and good investment options and flexibility and all the things that I wanted in it, right? But if you don't like your 401k and it has high cost, I'm not sure I would do this.
Yeah.
But I rolled my old IRA back into the Capita 401k plan. I can buy the same things because ours is really flexible. And then now I don't have any IRA money. So now I can make after-tax contributions to an IRA and convert them over to a Roth, subsequently convert them over to a Roth without tax.
So in this case, you kind of have like an empty IRA sitting there that you use this backdoor not backdoor, I don't want to get. But
I actually don't think it's that big of a problem,
Yeah.
but I think people get confused.
Yeah.
Anyway, keep going.
So you have an empty IRA, traditional IRA here that you can throw money into and then convert to Roth without having this big balance.
That has to take pro rata conversion rules. Cool. Exactly. Now, my wife, on the other hand, currently doesn't have a 401k plan available to her that she could roll her IRA into a current 401k. As once we had the twins, she decided to stay home and run the world. And so our world. So then she doesn't have a plan I could move her 401k or her IRA into.
Gotcha.
So this is a unique scenario. It wasn't insanely large, but it was a little bit painful where I actually paid a pretty hefty tax on converting all of her IRA over to Roth because I looked at it like we were in our mid to late 20s and I thought I have a lot of years here of after-tax contributions to traditional backdoor Roth that I could move over to Roth. But that balance that isn't crazy big, but it's still painful, is preventing it.
Yeah.
So I just converted the whole thing over and I bit that bullet 1 year. And then from here on out, we're able to do this strategy.
Perfect. I love that. And I know it's a personal story and all of that stuff, but I think that when people watch these videos and you're talking, again, on not the dogmatic side, but if you go, I guess in certain scenarios, you suggest that Roth isn't the right option for people. It's not that you don't like Roth. Like you do it yourself. We do it ourselves. We do it in certain situations. So it's not that we're against any of these. Yeah. There are situations where it definitely makes sense. There are situations where it doesn't. Don't get locked into one or the other when it's not advantageous.
And at different times in my life, at different income brackets, I have been on both and all sides of how I'm making my own personal contribution decisions. So it's not a this or that is the only answer. It's very dependent upon individual situations, this is educational in nature, right? Yeah. We're not talking to one person and saying, you do this, you do that. We're saying, here are the rules. Here's how you think. If you want to talk to us, of course, we'll talk to you about it.
Yeah. I think that leads right into number 12.
Okay, becoming religious about one or the other. We talked about this in the very first episode that you talked about where I just randomly came up with the idea. It's not like if you had to pick one utensil, it's not like, is it the fork, knife, or spoon? It's not like you would pick one for the rest of your life. Ideally, you'd have a fork and a spoon because it'd be really hard to eat soup with a fork and really hard to cut much with a spoon. And the bottom line is you want to have all the utensils. It's not one or the other. Have all the tools in your tool chest and make it so that you have the control in your taxes, in your tax situation in retirement. One caveat, do not over-index or overemphasize control, and you're trading an incredibly high tax pain today to have control later. Sometimes people will overdo the control side and be like, I'm going to control my tax bracket in retirement and I'm going to pay half of my income away to do it, because they just think that's the way they value that control in retirement. I would rather have someone with all traditional assets that if it saves them 20% difference in the tax cost, I'd rather them save the 20% earlier on and have very little tax control in retirement because maybe they're not likely to be in a high tax bracket anyway.
Yeah.
You don't need to control a non-problem.
Don't be religious about this.
Yeah.
Okay.
I mean, be religious if you want to, but not about this, right? Like don't
Stop it. Okay, number 13.
Number 13.
Could be its own video. Probably will be its own video.
It is. We got to do this one because I've got several examples that will walk you through it, but there are 2 5-year rules, and they are incredibly easy to confuse and get all mixed up. One of them is called the forever 5-year rule, and one of them is the 5-year conversion rule or the 5-year penalty rule. You might see it both ways. So what's going on here is there are, and without going into too much details, there are tax consequences if you withdraw money from a Roth too early, and meaning age-wise. And in addition to that, you've only held it for 2 or 3 or 4 years. If you've held it for 5 or more, it unlocks some of the withdrawal capabilities from the portfolio. When you get to 59 and a half, a lot of these rules tend to kind of not be a big deal.
Mm-hmm.
But mostly we're talking pre-59 and a half, and you want to start that clock. So if you have the ability to get money into a Roth IRA, whether it's conversion, contribution, something like that. And I'm not talking about Roth 401k because that has its own clock. I'm talking about Roth IRA clock. You want to just start it, even if with $100, just get it in there because that will start that 5-year clock, which will make it so you have fewer maybe tax limitations on the growth and less likely to be penalized or taxed on the growth and conversions and things like that. Each conversion has its own 5-year rule as well. When you take money out of a Roth IRA, it comes out in a very specific order. Nobody's telling you which dollars are which. You're in charge of tracking that, which is hard. So that's one piece of advice here for everybody, which is track how much you put in your Roths. That's it. So, and how much you convert. But money comes out as your own contributions first, then converted amounts, and then growth. They don't care if it's growth on conversions or growth on contributions or anything like that. You can just kind of lump it into growth. And the tax treatment is different on the first, second, and third buckets, whether it's contributions, conversions, or growth. And your age matters to that. Like you can take your contributions out at any time. You don't have to wait for any 5-year rules or any age or anything like that. You've already paid taxes on it. You can pull it back out. Ideally, you don't because growth on that money is free. So ideally, you leave it in, but you can take it out at any time. The 5-year rule starts to kick in on the converted amounts, and the forever 5-year rule is going to kick in on the growth in it. And there are little rules, and we'll go over that in another episode. But misunderstanding those rules can be a problem. And what I have found is that people misunderstand it to the side of thinking it will apply or be a problem, and it's not.
Got it.
They rarely, it seems, misthink it won't be a problem, and it is.
Yeah.
It's usually the other way.
Yeah. So going kind of tying our other conversations here, like when you had talked about in a previous video we've done, you can choose which lots to take out of investment. In this case, you're saying like the order of what's counting here on your Roth stuff is very organized.
Yeah, you can't choose.
You can't choose which ones. I don't want to take my gains first. I can't choose to do that.
Okay. Now, you probably would never.
Yeah.
There's a reason in investments you would,
Right.
Switch up the order because of the variability of individual investments over time. But yeah, it comes out contributions, conversions, growth.
Perfect. Okay.
They usually use the word earnings for that last category. Contributions. Whenever I say they, I'm most of the time talking about the IRS. So contributions, conversions, earnings.
Perfect. I think, did that tie 13 into 14?
Yeah, it did. That was 14. So number 13 is misunderstanding the 2 5-year rules. Number 14 is understanding the withdrawal order. Number 15, people who get to the doorstep of retirement, and we've had a lot of calls from even people like listeners of Retirement Nerds in my channel that are like, how do I figure out my lifetime Roth conversion plan? Because I know it's not the same conversion every year, might be 100 and then down to 10,000 and up to 40, or it might be everything. And they're having a hard time figuring out what is my plan. What they do when they figure out the plan is, this is actually a software problem. Some of the software will add up all the taxes paid over the entire life. And then they'll run a new scenario with or without conversions, altering the strategies. And then they'll give you the sum of all the taxes paid over your entire life in scenario 2. Here's the problem. If you give me a choice and say you have $1 million worth of tax bill for the rest of your life, and you can choose. You can pay $500,000 a year today and then a year from today. So you have to cover the full $1 million in 2025 and 2026. Or we think you're going to live for another 20 or 30 years. You can take 5% of that or 3-point-something% of that and just pay that every year for the rest of your life. I pick the procrastination route every time, right? I don't want to pay $500,000 when I could pay 30 or 40,000 and then gradually, pay that over a long period of time.
Yeah.
So how do you normalize for that? Well, you say it's called a net present value calculation. That's a financial advisor term. The real people term is pretend you set up an escrow account. How much money would you need to put in it if you could earn a rate of return on that? Let's say it's 5% or 6 or 7 or 8. Well, you pick the rate of return. How much money do you need to put in your escrow account in order for it to self-pay all your taxes for the rest of your life? And you'd have to put almost $1 million in the first scenario because you don't have any time to make the money. So the net present value of the two $500,000 payments is going to be like $900 and something thousand. That's what it's going to cost you in 25 to put it into an account to be able to cover this year's, which got no growth because it was an immediate, and next year's, which got 1 year's worth of growth, and that's it. So it's $900 and something thousand. But if you have to pay just 1/20th or 1/30th of it every single year, you have money you got to leave in there for 10, 15, 20, almost 30 years. You don't need nearly as much. It's going to bring that number down to $300,000, $400,000 in today's. That's the net present value, the present value of all those future payments. And some of the software just tells you, well, it's equal. Those two scenarios are equal because they're both $1 million. It's like, well, wait a second. Those are not equal to me.
Yeah.
I don't want to pay that much up front.
Gotcha. And so this is the important thing on whether probably a Roth conversion here, of like if you're paying all of that tax upfront in that year or the years that you're doing that Roth conversion rather than maybe spacing it out over time.
Yes, and maybe or maybe not, because what I'm saying is it could make sense to do a lot of conversions right away and clear out your IRA. Maybe because that decreases tax on Social Security and therefore that goes away and it has this domino effect, this positive domino effect. The problem is that most software is not thinking about, well, $10,000 of payments in taxes today versus in the future is not the same.
Got it.
So in other words, you come up with false optimal scenarios that are not right. You come up with optimal quote optimal scenarios that are not truly optimal because they're just summing up all the taxes paid.
And I think that part of that optimal scenarios might lead into our last topic here. So the 16th, our final one. Thank you to those who have made it this far.
For real. Sweet 16 here. So
Is that a code word?
That is the code word. That's what we're going to do. So if you've made it this far, comment Sweet 16. Erik likes to know who's made it this far.
Comment management.
What'd you say?
Comment management. Like if I see the Sweet 16 comment in there, then I'm like,
I thought you said
okay.
you wanted to comment management.
No.
Yes. This is how Erik knows that you're diehard, is if you get to the end and you know the code words, which people do. I've been impressed.
Yeah.
So I'm wearing my Kuru shoes from last session.
Last code word.
That was last session's code word. Okay, so number 16 is not seeing the new realities created from having done Roth conversions. Let's say you only have one lever to pull, traditional IRA withdrawal. So you know when I take income from my portfolio, I'm paying taxes on it. But then you do a Roth conversion. Let's say you have $1 million of IRA balances. And let's say you only go over from the 12% to the 22% tax bracket by $10,000. So you're going over it, but not a ton. So you do a $100,000 Roth conversion. And you're thinking, I'm going to pay 22% on this and maybe some 24, but I'm okay with that. Or maybe I split the $100,000 Roth conversion over 5 years leading up to retirement. And so I'm able to sneak it all in at 22% every year. Okay. That $100,000 sitting in Roth has created a new reality. And I am like a nerd for Marvel and Star Wars and all those things. Yeah. This is the moment when I think it was Hulk was talking to the stone keeper, the lady, well, I don't remember her name, and she talks about how she takes the stone out and it like creates a new alternative reality. Like that's what we're doing. That Roth conversion is like moving the time stone just a little bit, and a new retirement tax alternative exists for that person. With one conversion, it changes the levers you have available to you in the future. So some people think, I've got to go all the way, one way or the other, or they start to convert and they don't realize that they now are operating under a new construct. So the new construct in the example I'm just giving everybody here is you were in retirement, supposedly, if you didn't do any conversions, you were going to have to pay 22% tax on $10,000 every year. But having done 1 or 2 or 3 years worth of conversions, and now you have this $100,000 Roth, well, now you can take Social Security, fill in with traditional, and then as soon as you hit that line where it flips from 12 to 22, you just stop your traditional IRA contributions and you take that $10,000 from the Roth. And technically, you don't even need 10 because the traditional, when you took the 10, you had to pay taxes on it. So maybe it was $8,000 net or $8,500 net because your tax rate in retirement is a little bit better. But technically, that was 22%. So it probably was closer to $7,000, $7,500 after state tax. So let's just keep it easy. The $10,000 net to you came to $7,500. So we can take this $100,000 Roth IRA, withdraw $7,500 from it every year, and we are in the same net cash flow as somebody who didn't do any conversions. And we have potentially, depending on what rate you were able to convert. Now, the ideal scenario is they had a dip in their income at some point, and we snuck that $100,000 worth of conversions in at 12. In that scenario, we swapped 12 for a future 22, and we won. The client won.
Yeah.
So that is showing how just one conversion or 2 conversions might be enough to create an optimal scenario in which you can control and manage to the target bracket that you want. And so in the next episode or time we chat about this, I'll talk about how to do this right. How do you do Roth conversion planning right? But one of the biggest mistakes I think, well, all these are pretty easy to make, right? But I think one of the big mistakes people make when they look at the long-term projection is they don't understand the new reality they sit in after 1 or 2 or 3 conversions.
And again, going back to all the softwares that people use, and I hear people talk about Bolden and all these other things, like I feel like softwares struggle with this.
They do. And I've, since talking with people and seeing comments, we've gone into Bolden. I've messed with it. I bought it myself because I'm just like, I got to see what's going on in there. It's a great tool. I like it. I like how intuitive it is. I think it's really easy to use. I do not think it has the capability to appropriately model out really efficient marginal tax bracket management in retirement.
And I think part of that goes to what you were just talking about too, of that new reality is a lot of these softwares automatically assume traditional stuff comes out all the way down.
And Bolden does allow you to change the order in which you draw down your assets. And you can even, I can't remember, but I think you can set percentages, but it's got to be better. It's got to be better than percentages because it's not going to be a set proportion for every year in retirement. It has to be managed to certain tax brackets. I need to be able to choose, like, is it the 12 to 22 line, the 22 to 24, the 24 and up? Is it just underneath 10? Or what line do I want to manage to? And then RMDs, required minimum distributions, trump that. Unless they're doing charitable giving, can I build that in? And QCD will pull out of the RMD. So there's just too many variables for, I think we could build it and we're working on it, but it's a bit of a mess. The ability to show proper tax management is easy to build. What I'm having a hard time with is AP Calculus was my junior year in high school. There's some sort of derivative or integral that shows or Monte Carlo simulation that shows after one conversion, here are all the pathways and we find that to be the most optimal. after 2 conversions, here are all the pathways we find that to be most optimal. And then taking the most optimal after each year's and comparing those against each other, that's where I've yet to find anything even close to that.
That's a Dr. Strange moment there.
It is a Dr. Strange moment. There's just one. That's so true. Anyway, okay, we got through it.
We got through all 16.
Comment Suite 16.
Yeah.
And of course, if people want to talk to us, we're happy to go through this. We're going to talk about how to do it right.
Yeah.
But if people want to talk to us at capitafinancialnetwork.com.
Well, and your channel is great for this stuff. I feel like I'm able to come at this from like a not financial mind and ask questions that maybe that group has. And then like your channel is very, very great. So
yeah, it's more fun with you than it is by myself.
Don't tell Tyson.
Don't tell Tyson. That's funny. No, we try to keep them maybe a little bit shorter and just hit the facts and dive in. Whereas I think you bring an opportunity for us to kind of talk through situations a little bit more. So yeah, it's a different feel, but either way, whatever helps you get there.
I appreciate your time. And then again, for those watching, I hope that they appreciate it as well. And we'll keep going with this because there's a lot in the Roth conversation. There's a lot of attention around it. And so I think that you bringing the light to it in such an open and honest and kind of transparent dialogue helps people, whether they're doing it themselves or they're looking for their advisors. And I even think like as they go to their own advisor, if it's not you, there's so many people that reach out to me saying like, I'm armed so well now to go talk to my advisor about concepts that I didn't understand. And I get that on the Medicare side too. And like, that makes me happy. Like, it's like, great, you're not using us, that's fine. But you're more prepared and you're having better outcomes out in the world.
Yeah, it does feel like it's benefiting 3 populations. And one of them is the DIYers that are content and feel like they have the tools to be able to think through it better. 2 is, like you said, the person who has a financial advisor and is trying to figure out how to communicate with them in the right terms or ensure that they're getting this type of planning. And then, of course, our clients and people that want to reach out to us. So it's been really good.
Very great. Thanks, Zacc.
Thanks, Erik. Appreciate it.